So, Aaron, for someone who worked in Hong Kong, maybe you could take this. The question is, would this crisis spell the end of the China growth story, even assuming a Democrat victory in the US elections?
Uh, I would say that the China story will not be over, but it will be different from the one that we saw in the past. I think China's economic growth was and is still, a bit of a split. The export market component of the economy is quite important. But over time, it has actually fallen off from where it was maybe 10 years ago. Domestic consumption has been picking up. Today, if you look at the Chinese economy, services part of the economy is over 50% of the economy, which is basically all kinds of services, consumption that goes on. So China's economy is evolving. And I think this trend of the fact that if you get deglobalization, I think the Chinese will accelerate the so-called necessary changes and reforms to make sure that China evolves into a much more domestic consumption play. And if you look at the stock market, the stocks that have done very, very well, actually is not the industrial old economy stocks. It's been mostly the new economy stocks on the technology side, on the consumption side. So I think the economic structure will change. Growth rates will not be what we've seen in the past. I think China was slowing down even before this. And I think, the realistic goal growth for an economy the size of China would be more realistic between, I'll say, in the long term now, maybe between 3 to 5% rather than what it used to be between 6 to 8%, because the size of the economy has just grown too big. So, it will slow down. It's just a question of numbers. You can't continue growing at that pace. So I do believe that, yes, the nature of the beast will change, but the beast will still remain.
Thanks, Aaron. Mansoor, you mentioned that you believe the dollar will continue. So there's a question here that I'd like to share. Do you feel the US dollar will continue to remain strong going forward when interest rates are zero and there is huge amounts of monetary expansion? So I would imagine this is in the medium term, probably a year or two out.
Okay, well, thanks for the question. Mandeep, we believe that in the short term, we think the dollar is going to stay bid. It is the reserve currency. And as Hareen was saying, that the velocity of money has been falling. But if the world economy starts opening up, then they may be a bid to the dollar. I have no doubt that if the Fed starts printing an enormous amount more of money, that the dollar is going to resume its big downtrend. But in the short term, we believe the dollar will be buoyant. And in terms of the amount of printing they've done, in respect to the total number of dollars floating around, it's not as big. Now, if the Fed balance sheet starts hitting 15 trillion or something like that, that might have a negative impact. But really, in terms of trouble, everyone still runs to the dollar.
Thanks, Mansoor. Nirman, what would be the effect of all the liquidity and credit that has flooded in the market now when the normal economy returns?
Well, I think that's potentially slightly negative for credit investors over the longer term, because all the liquidity will, like you've seen in the past, chase financial assets and like depress yields. At the moment the yields are still attractive, but over a slightly longer time frame that may not be the case. The good thing is that companies are able to refinance, at least solvent companies who had a good business model and were doing relatively okay pre-COVID, are able to raise capital. Companies will not default for liquidity reasons, which is the Fed's intention. But it doesn't solve the solvency side of things. And if there's no demand, post the opening up, then there could be solvency issues, which I don't think liquidity can solve. So it will be interesting to watch. I think some of the companies which are insolvent or will have challenged balance sheets and business models, they're already trading at a very low sort of distressed level. So those bonds are already cheap, or factoring in a high chance of default. I'm more constructive on the credit market. Of course, longer term, these liquidity will be more challenging in terms of longer term returns for investors.
Well, I guess an extension of this question would be, what's your worst case expectations on inflation going forward? Again, about years.
I guess in the near term, Mandeep, I wouldn't think that inflation is an issue. Of course, at the moment, we are more worried about deflation. But I think next year onwards, maybe going into 2022, as the base effects, as well as all the monetary supply that is being pumped into the system, as well as if the velocity of money increases, we could see inflation coming back. But the demographic trends and the technological trends are clearly pushing inflation down from a structural perspective. And wage inflation is also not very high, primarily also due to technological factors. So those longer term trends are still in play, and those really don't depend upon monetary factors.
Thanks, Imran. Harun, a more fundamental question, since you were discussing the macro situation. The question is, if we have never experienced this kind of a situation before, is there really any point in believing the V, U, J, L models? Because there's simply no past data to model. What's your take on that?
Yes, I think people like to put some kind of a graphic picture as to how things will evolve, and then that's what you hear, this V, U, L, the Nike swoosh and all this stuff that we hear about. But the way I would say is that if we always tend to look at past experiences to kind of give us a gauge as to where we go forward. Central banks and governments are doing things which are completely unprecedented, as I said earlier. Similarly, I think we're dealing with a medical issue here. So it's not about like the way we had back then. You put the money in and you can kind of repair the banks and we move on. Here, people are finding it hard in terms of getting back to the normal way of doing things. Now, if you ask me for the next 6 months, are things going to look easier? I don't think so. But I think, being an optimist, I would say that chances are that maybe in a couple of years, either we'll get the herd immunity or we will find a vaccine that kind of gives some level of protection, that, people will get back to a more, at least a more open economic activity. I don't think it'll go back to the normal. That's why I call it the new normal. But I would say that, the markets are discounting a V, because if you look at the way they have bounced back, saying that things will come back to normal much faster. But my take is that, it will take a much longer time. So maybe, we have fallen sharply. We might get a Nike swoosh kind of thing, and it will take time for the economy to get back to where we were just a few months back, maybe by the end of next year or maybe even 2022. So it's not going to be an easy ride. It has a lot of factors that we can't control, but you have to put some structure to it in order to have an investment strategy.
Thanks, Harun. Mansoor, I know Taurus's view is quite positive gold. So since it's not one of the 3 core themes, I'd like to pose this question to you. Is gold going to become a mandatory part of everyone's portfolio, including sovereign funds?
I believe so. I do believe so. We are not active in gold because of the volatility impact it has on the portfolio. My only caution would be, because of the amount of dollar debt being raised in emerging markets, they may be about of selling in gold. I know they've been accumulating for a while. This is just conjecture on my part. But I do believe there is a significant part that gold would play in long-term portfolios, as Irene has alluded to, and I've had discussions with them about that, that I think gold will be a very important part of people's portfolio going forward. If they've got time frames of 3 to 5 years. We're very tactical oriented, so gold rarely shows up in our portfolio.
Sure. Aaron, can you talk a bit more about gold and why?
Yeah, I think we have been bullish about gold. I think it's been about 18 months ago when we kind of turned, simply because we took a very simple view that, you know, if you look at what governments around the world were doing even back then before this crisis, is that there was a lot of debt being issued, and fiscal deficits especially, and central banks around the world trying to keep the growth picture keep on chugging along, were cutting interest rates at a time when we were at technically, I would say, peak economic cycle. So it was a very funny situation. Usually interest rates go up in periods where, you know, the economy is doing well. Here interest rates were going down when the economies were still doing relatively well. Now, when we got hit by this crisis, I think it gave us that second validation to say that, you know, in a way, the money supply is growing exponentially, in a sense that governments are printing money. If you look at the US budget deficit this year, is going to be huge, you know, somewhere close to, you know, maybe $4.5 trillion, assuming that they don't come up with another stimulus budget. And the central bank also has been, in a way, monetizing that, because they have been expanding their balance sheet, and this is happening all over the world. So when you do it at that rate, basically you're increasing the supply of money, and interest rates being zero, there's no cost of holding gold. Gold becomes a store of value. So I think in dollar terms, you know, you could see the price of gold go a lot higher, simply because it's just a relative value proposition at the moment. So one, the supply of dollars is increasing. On the other side, you can't increase the supply of gold that rapidly, and so people buy gold because it's cheap to hold it.
Thanks, Haran. Nirman, a question on credit markets, but this is quite specific. How do you think the Indian credit market is expected to perform given the impact of the Templeton bond fund issue in India?
I think it's a short term. Obviously, it's a negative. I mean, but from what I've read, they will be unwinding that over a period of years and not immediately. So it is not as negative. But it clearly it highlights the fragility of companies and business models which heavily depend upon wholesale funding, and on the other side are lending longer term or have poor sort of underwriting standards. So those were anyways challenged, but some events like the fund is pulling out of India does tend to pull liquidity out. But on the other side, there are several portfolio investors who are also I'm looking at India at cheaper valuations from a variety of asset classes. Like we have seen Facebook come in with the investment into Geo, like the Reliance Geo business, and other private equity players also getting involved. So for the right assets, there is demand in India. So the liquidity is going out, but it is also coming in for the right sectors and for the right assets. So I would say it's a balanced picture. On the margin, India could be a beneficiary of the deglobalization or reorientation of the supply chains, but that I think remains to be seen. There are several challenges that the Indian government has to overcome to win that share of business.
Thanks, Nirman. And, one more question for you, Mansoor. In the current macro environment, I know you follow trends, more global macro, but do you have any specific sectors that you think are going to be the potential winners over the next few years?
In terms of what?
Essentially, well, sectors within the equity market.
Oh, well, I think, again, sorry, Hareen, I keep on going back to your presentation, but I think, what Hareen pointed out was pretty important to us, and I think we're thinking the same way. I think the leaders will continue to lead. I think the resiliency of technology is going to show itself, and I think the top 5-6 guys have done that, and they're carrying the equity markets themselves, and I think that sector is going to do really well. I think the office sector, the obvious stuff is the office sector globally is not going to do well. People are going to be working remotely and stuff like that. So, not that we play the real estate market, but I think on the equity side, we're going to focus on people that are going to make, companies that are going to make operating from home much better. REITs, in the US might not do as well. Focusing on resilient technology, which we believe makes our life easier, working remotely, et cetera, et cetera. I don't know. We have to reimagine the world, and we're in the process of doing that, even with our portfolio. But I think, during Hari's presentation, he alluded to the big changes that are happening. That's what we're thinking. We don't have any specific equity recommendations, but sector-wise, we think the technology leaders are going to stay resilient and do very well.
Okay, thank you. I'm going to go with the last two questions, given the paucity of time. So a quick one, Nirman, would be on in the next 3 to 6 months, I know you're a fixed income expert, but I do know that you follow equities quite carefully. So do you have on Asian equities, what's your view on Asian equities for the next 3 to 6 months?
I think that will be more a function of the growth trajectory coming out of the COVID crisis. Like Mansoor mentioned, certain trends that were prevalent even pre-COVID are getting more accelerated now. So technology is certainly one of them. I think healthcare could be another one. Given that the demographic changes that Asia is seeing with the aging sort of economy that was already in play, and after the coronavirus, I think that is really a big focus for everyone. And not just healthcare, but in general, I think companies that benefit from healthy lifestyle, so sportswear or healthy nutrition and these kind of things as well. So I think Southeast Asia should be able, and broadly I think Asia should be able to come out of the coronavirus. Of course, the China concerns are definitely there because there is a huge challenge in terms of many countries or many companies wanting to at least have a more balanced supply chain. So that could be on the margin negative for China, but again they could like Harin mentioned earlier, reorient their economy towards more consumption. So this transition phase is important, and how the government is able to manage that, it would be interesting to see that. As far as India is concerned, I think it is more challenging because we have a banking sector that was already in the problem. But valuations already I think show that we could see some more volatility, but again it depends upon the level of activity coming out of the crisis. Certainly there's a lot of savings that has been built up because there's no consumption, so there would be this burst of some consumption just out of the crisis. So it could be volatile over the next few months, but the longer term trends are like still in play.
Thanks. The last question, I'm going to pose it both to Mansoor and Harin. Given all that we've said, so is the probability higher for a retest of the lows of the markets, or will it be steady from here? Harin, go ahead first.
Okay, that's not an easy question. But if I were to allude back to my slides, and I would say that the markets are not being realistic in terms of their expectations of where the economy will be. My take is that we may not go back to those lows unless we get a huge spike in infections again and everything shuts down. But assuming that the growth is lower than what the market is anticipating and companies struggle in terms of getting back onto their feet over the course of the next few quarters, then I think the market could go down and bring it back to a more realistic levels in terms of valuation. I think the only thing that really is keeping this market afloat is that there is a lot of liquidity, and that liquidity has got right now nowhere to go. And if you look on a relative basis, when interest rates are zero, bond yields are low, people tend to gravitate towards equities, and so the fall may not be big, but even if, let's say we get some shocks maybe from the China-US tensions, and then the markets could go back and, retest a slightly lower levels, maybe a 10-15% correction, but I don't see it going back to the 2200 levels, bearing a huge surge in infections.
Thanks, Harun. Mansoor, your take on specifics on the S&P, does it go back to its lows or does it remain?
Well, eventually we believe that. I mean, I think the market's going to vacillate between the pandemic fears and the stimulus cheers, but I think the fear has been ingrained. And I don't think we've seen the last of the solvency issues. I think those are going to crop up and the reality of everything. But I think it's going to be a slow grind down. I'm a little bit more pessimistic, medium term compared to Harun. But short term, we're pretty bullish right now. At least that's what the book tells me.
Thanks very much. We've pretty much run out of time now, so I'm going to pass it over to Deepika.
Thank you, Mandeep, and thanks a lot, Harun and Mansoor and Nirman. Really very, very interesting conversation. I think these are absolutely amazing times. It's almost impossible to imagine what tomorrow will look like, and next month is another question of a different order. But very helpful to get your views. Thank you for sharing with us. And I'd also like to thank the audience participants for staying with us for an hour and spending their weekend with us. Thank you all, and have a great evening and enjoy the weekend.
Thank you.
Thank you.
Thank you.